mixed income statement and balance sheet accounts. So, under mixed income statement, balance sheet, and accounts, it involves at least one nominal account and one real account. These errors are divided into counterbalancing errors and non-counterbalancing errors. We'll start with the first one. So counterbalancing errors are errors which is automatically counterbalanced over two periods, meaning it corrects itself over two periods. So if it was discovered 3 or 5 years later, there's really no need to make any correcting entry because it is counterbalanced. It is automatically corrected over two periods. So for the income statement for the current year, that would be incorrect. Same with the balance sheet. Income statement in the succeeding years is still incorrect. However, after the immediately succeeding years, it is automatically corrected. That's if no correcting entry was made. For the balance sheet, only the current year is incorrect. All succeeding years is automatically correct. So before we proceed with the discussion, it's important that you know the relationship among accounts, whether direct or indirect. Okay, so let's have some sort of exercise, relationship among certain accounts. If sales is understated, net income is understated as well. For us to have a better exercise, let's have this uh, sample income statement. So we have, let's just say we have sales 100,000. You have then cost of goods sold starts with inventory beginning, purchases, inventory less inventory end. Let's just say this is 50,000, 150,000, 30,000. Let's change this to 300,000. So your cost of goods sold would be inventory beginning plus purchases minus inventory end. Then you have your gross profit. Gross profit is sales minus cost of goods sold plus other income. That would, let's just say it's 80,000. Let's make it 80,000. What's your total income? Less operating expenses. Let's just say it's 50,000. Net income. Okay. Okay. So first one, if the sales is understated, net income is. So the current net income is 110,000. Let's understate the sales. How will it affect net income? Let's make it 200,000. So from 110,000, it went down to 10,000. That would mean if this is decreased, net income will also decrease. Okay. So if this one is increased, let's make it 500,000. This one will also increase. That would mean sales and net income is directly related. Sales increase, net income increase. the sales decrease, net income also decrease. How about the relationship between purchases and cost of goods sold? So this is your cost of goods sold. It's currently 170,000. So if you're going to overstate purchases, let's make this 200,000. How will it affect cost of goods sold? It becomes 220,000. So from 170, it went up to 220,000. So if purchases is overstated, that would mean cost of goods sold is also overstated. So this is directly related. How about purchases and net income? If we're going to understate purchases, let's make it 100,000. The current net income is 110. So if you understate purchases, let's make it 100,000. Net income went up to 160,000. That means if the purchases is understated, your net income is overstated. So if purchases is understated, net income is overstated, that would mean they have indirect relationship, opposite. So if inventory beginning is overstated, how does it affect cost of goods sold? So you have inventory 50,000, cost of goods sold is 170. So let's overstate beginning inventory. Let's make this 100,000. So your cost of goods sold from 170,000, it went up to 220,000. So if this is increased or overstated, your cost of goods sold is also overstated. That means cost of goods sold and beginning inventory is directly related. How about inventory end? So the first one is beginning inventory end income. So the current income is 110,000. Current inventory is 30,000. Let's make this one 50,000. So your net income from 110, it went up to 130,000. So if this is overstated, net income is also overstated for the same amount. Okay. So if they have the same effect, the same, if they're the same, inventory and net income, that would mean they are both directly related. So here's a summary of the relationship between accounts. You just pause the video and try to familiarize. Move on now to examples. First, you have overstatement or understatement of sales. So the entity failed to record a credit sale of 200,000 in the current year 2020. The same was recorded during the early part of 2021. So it is rightfully should have been recorded in the 2020, but was mistakenly recorded in the 2021. As a result, the accounts receivable and the sales for the current year is understated by 200,000. That means 2020 income statement is incorrect. So sales is understated. It follows net income is also understated. 2020 balance sheet is also incorrect because you were not able to record AR. AR is understated. And since net income is understated and net income is close to retained earnings, it follows retained earnings. Retained earnings is also understated. Now for 2021, the sales for this year is overstated because it was erroneously recorded in 2021. The sales for this year is overstated by 200,000. That would mean the income statement is incorrect. 200,000. However, the balance sheet is already correct. So, first, your accounts receivable is now correct because the understatement made in the previous year is counterbalanced by the overstatement in the current year. So understated by 200,000 in 2020, then 2021 overstated by 200,000. So it is counterbalanced. The same thing with retained earnings. Your net income last year is understated. That means retained earnings is understated. But since your current income, in 2020 and 2021 income is overstated, As a result, your retained earnings has now been counterbalanced. So if we're going to look at the table we have shown earlier, um, you will notice that the first year, it is erroneous, the same with the balance sheet. Immediately succeeding year, the income statement is still in error. However, the balance sheet on that year is already correct because it's already counterbalanced. Ending the succeeding years, both income statement and balance sheet is correct, assuming there's no correcting entry that have been made. So, if the error was discovered in 2020, of course, you should make the appropriate correcting entries, and that would be debit sales, credit AR, because that would be debit AR, credit sales, because your AR in sales are understated if it is discovered in 2020. However, if it is discovered in 2021, what you're going to do first is you debit sales. Why debit sales? Because in 2021, your sales has been overstated. Okay? So you debit sales in order to decrease, in order to correct. And why credit retained earnings beginning? Okay? That is specific, beginning. It's because the net income last year was understated, and net income is close to retained earnings. So retained earnings end is also understated. Now, the ending balance of your retained earnings will be the beginning balance of your retained earnings next year. So it follows that the beginning balance of retained earnings in 2021 is also understated. And that's why, to correct the understatement of the beginning balance, you're going to credit retained earnings. Okay? Credit retained earnings in order to correct the understatement of retained earnings last year. And it should be January 1, 2021, because the ending balance last year is the beginning balance this year. Now, if the error is discovered in 2022, no need for any correcting entry because the overstatement in 2020 is counterbalanced in 2021, just as shown in the table we presented earlier. Now, understatement of purchases. The entity purchased 200,000 worth of inventory in credit. It was correctly included in the physical count at the end of the year. However, it was recorded, the purchases was only recorded in 2021. Okay, so instead of recording it in 2020, it was mistakenly recorded in 2021. However, as per inventory, it was correctly included in the physical count. So inventory is correctly stated. The only error committed is the purchases. So for 2020, purchases and accounts payable is understated. As a result, by the way, purchases, you have nominal account, accounts payable, you have real account. So income statement for 2020 is incorrect because it is overstated, meaning the net income is overstated. Remember the relationship between purchases and net income. It's indirect. So if purchases is understated, it follows net income is overstated. Balance sheet for 2020 is also incorrect. First, AP is understated because you were not able to recognize the liability. And because net income is close to retained earnings and your net income is overstated, it follows retained earnings is also overstated. And then you have purchases. Purchases for 2021 is now overstated because it has been erroneously included in 2021. So if it is overstated, that would mean net income is understated. So income statement for 2021, kindly change this one, this is 2021, is incorrect because it is understated. However, the balance sheet, accounts payable and retained earnings is already correct. So the understatement of accounts payable in 2020 is counterbalanced by the overstatement of accounts payable in accounts payable in 2021. So it's counterbalance. Same thing for retained earnings. Since 2020 income is overstated, 2021 income is understated, the overstatement in the prior year is counterbalanced in the understatement in the current year. So it's counterbalanced. So it still follows the table we have provided earlier. Now, what are the correcting entries? Okay. First, if it is discovered in 2021, remember your 2020 income statement is overstated, so retained earnings is overstated. The ending balance of retained earnings in 2020 is your beginning balance of retained earnings in 2021. So that would mean retained earnings beginning is also overstated. So in order to correct this one, debit retained earnings January 1, 2021. We just add a date, retained earnings dash January 1, 2021. Debit in order to correct the overstatement in the retained earnings. And because the purchases for the current year is overstated, you need to reduce it. So credit purchases. If it is discovered in 2022, there's no need for any correcting entry because it is counterbalanced. The errors in 2020 is counterbalanced in 2021. An overstatement of ending inventory. So sometimes an entity will include in its physical count goods consigned by consignors. So for example, your entity is a consignee of certain inventories. That consigned good is should rightfully belong to the consignor, not to the consignee, because you don't own that goods. The physical count conducted in 2020 inadvertently included 150,000 worth of consigned goods from the consignor. Again, that should be included as part of the consignor and not by the consignee. So inventory end is overstated. Of course, inventory and net income, remember, the relationship is direct. So if inventory end is overstated, income statement is also overstated. So balance sheet is incorrect. First, inventory end is overstated. Also, since retained earnings is close, net income is close to retained earnings is also overstated. For 2021, our ending inventory in 2020 becomes the beginning inventory for 2021. So if our ending inventory is overstated, then our inventory beginning in the succeeding year is also overstated. Now, how is inventory beginning related to net income? They are indirectly related. So if this is overstated, then net income is understated. Okay. So if your net income is understated, it follows the retained earnings for that current year will be counterbalanced. So the overstatement is counterbalanced by the subsequent understatement. For the balance sheet, first inventory end is already correct. Why? The inventory end last year is the inventory beginning this year. So the inventory end this year, assuming there are no mistakes in conducting the physical count, meaning the consigned goods was rightfully excluded in the count, then the inventory end this year is already correct. It's in no way related with the inventory beginning or inventory end last year. So this is determined by another physical count. So inventory end is already correct. Your retained earnings end is also correct because the overstatement in the previous year is counterbalanced by the understatement in the current year. So if you discovered this error in 2021, first debit retained earnings. If you remember, your income is overstated, then your retained earnings is overstated. Retained earnings end is the retained earnings beginning. So if this is overstated, retained earnings beginning for 2021 is also overstated. So in order to correct that one, debit retained earnings, reduce retained earnings beginning. And then credit inventory beginning January 1, 2021. Your ending inventory is your beginning inventory in 2021. So if this is overstated, then the beginning inventory is overstated as well. So what you're going to do in order to correct the overstatement, you credit, reduce it. However, if it is discovered in 2022, then there's no need to have any correcting entry because it is automatically counterbalanced.